Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is September 2nd, 2025. I am Luna.
I am JPMorgan.
So in the latest trading session, U.S. stocks, they pulled back a bit. The S&P 500 dipped, about 0.6% after hitting some pretty amazing highs. It seems like mostly profit-taking, ahead of the long weekend. But the big headline, the story everyone's buzzing about, that's got to be gold. It just smashed another record high.
Yeah, it's fascinating, isn't it? Gold jumped about 1.4%, pushing it over $3,500 an ounce, an all-time high. And this wasn't just out of the blue. It's largely tied to this growing feeling that the Federal Reserve, that they're going to cut interest rates pretty soon. See, when rates look like they're heading down, the dollar usually weakens a bit. And that makes gold more appealing, as a safe place to park money. Plus, it's cheaper for buyers using other currencies. But at the same time, you've got long-term bond yields still climbing globally. It's almost like seeing a financial dinosaur reappear. Germany's 30-year yield, for example, hit a 14-year high, around 3.38%. That tells you investors are pretty worried about heavy government spending and, inflation risks pushing those bond prices down.
Huh. So gold's flying high because people expect rate cuts, but bond yields are creeping up because of spending fears. It's kind of a good news, bad news situation, right?
Exactly. It's a real push and pull.
And it gets even thicker when you look beyond the big markets. We've got some surprising economic signals coming out, especially from Asia.
Absolutely. Take China's Caixin Manufacturing PMI. Now, that's a key number for factory health. Anything over 50 means growth. Well, it unexpectedly bounced back into expansion territory in August, hit 50.5, actually beat the forecasts. This might mean China's factory sector is stabilizing, which, helps calm some global growth worries. It gave a bit of a lift to commodities and Asian stocks.
Okay, so a positive surprise there.
Yeah, but then you look at South Korea, their export growth slowed way down, just 1.3% year on year, and a big chunk of that seems to be down to new U.S. tariffs hitting their shipments. So it really highlights how these ongoing trade tensions are, creating very real impacts on supply chains.
Wow, yeah, that's a sharp contrast. China showing some unexpected strength, but South Korea feeling the direct pinch from trade policy. And these economic ripples are always bumping up against, the bigger geopolitical waves. Let's talk about some major macro stuff that's shaking things up.
For sure. Look at the Ukrainian drone strikes, for instance. They apparently disabled something like 17% of Russia's oil processing capacity. That caused Brent crude prices to jump about 0.9%. Supply worries, obviously.
Right, and that's not just about paying a bit more at the pump.
Exactly. It brings those inflation worries right back to the forefront. It could mess with central banks' plans to cool things down, maybe even push back those rate cut expectations we were talking about. And then on a totally different track, you had a U.S. appeals court decision that kind of weakened many of those Trump-era emergency tariffs. So that could offer some relief for industries that were hit hard. Although word is the Treasury is already working on a plan B. So these global movements, they just really show how delicate the balance is right now. You've got geopolitics, trade policy twists, all creating these big ripple effects through the markets.
Okay, so wrapping your head around all that, what does it mean for you? What should you be watching in the next few days?
Well, everyone's going to be laser focused on Friday, September 5th. That's when we get the U.S. August employment report.
And the economists, they're forecasting around 75,000 new non-farm jobs. That's jobs outside farming. So definitely a slower pace if that holds true.
Yeah, that report is absolutely critical because if the number comes in weaker than expected, like those forecasts suggest, it just adds fuel to the fire for Fed rate cuts. That would likely give stocks a boost, maybe even cryptos. But if we get strong job growth instead,
Delays those rate cut hopes again.
Precisely. It could push them back significantly. Oh, and also keep an eye on the U.S. Treasury debt auctions happening through September 11th. They're going to be a real test of whether the bond market still has appetite for all this new debt, especially with yields already pretty high. That could really influence where interest rates go next.
So we're really navigating this tricky environment. You've got cooling growth kind of nudging central banks towards easing up. But then you've got these specific pressures like tariffs, the conflict stuff, government spending worries, all constantly tugging the other way. It's quite the balancing act.
Yeah, it really is. And I think the key takeaway from looking at all this today is that these big market trends, they might be hiding some pretty significant risks in specific sectors. Things tied to energy or things heavily exposed to trade policy. So it really raises a crucial question for you. How robust are your current hedges? Are they really built to withstand these kinds of localized but still globally significant shocks? Or are they maybe set up for a more, let's say, predictable economic path? Something to think about.
You've seen the headlines. But what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts, and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai, know what moves your money.